Coming up, Will Lin comes back. He's going to talk to us about the state of innovation in security with some insights for the founders, the security leaders, and those of us just paying attention on the sidelines. We're going to cover our innovation updates, including a $50 million launch of a foundation. And I think that's pretty good for all of us. We'll discuss it. And you get the conclusion of our fantastic interview series with Sean D'Souza, author of The Brain Audit. Business Security Weekly starts now.
This is Security Weekly, for security professionals, by security professionals. Broadcasting live from G-Unit Studios in Rhode Island, it's the show about security startups, how to secure your startup, and advice for security startups. It's Business Security Weekly.
I need it from the top.
Brought to you by, do you have a website, an external presence, employees, an office? Any of these things can be compromised and attacked. How are you defending your assets? Have you penetration tested your public assets? Start 2018 by taking a proactive approach to securing your vulnerable areas. Black Hills Information Security has been helping companies find their weaknesses since 2008. Email consulting at blackhillsinfosec.com and see how they can help you sleep better at night.
Hey, everybody, and welcome to Business Security Weekly. We made it to episode number 75. We're recording it live Friday, February 23rd, 2018. This is the show where we explore the business of security to improve the security of business. We're your trusted source, actionable insights, leadership, communication, and innovation. Today, we're going to focus heavy on that innovation. I try to be your straight-talking guide, help you overcome friction, unlock value faster. Michael Santarcangelo. And I do hang out on a beach most of the time. Actually, I live near it. I don't go to it very often. Another person that I enjoy, Matt Alderman's joining us this week. Paul's on vacation. We call Matt the Wizard of Entrepreneurship. Actually, he's like a fellow value seeker. You guys should see what happens. Matt and I get in front of a whiteboard. It fills up fast with squiggles and arrows and stuff all over the place. And it's a good time. So I'm so excited when you join us. So Matt, welcome back. And how are you doing today?
Great, thank you. Yeah, it's been, 3 weeks? Yeah, we were together about 3 weeks ago, squiggling on the whiteboard together. So it's good to be back after a few weeks.
Yeah, and look at how clean that is. I got to take some lessons on cleaning up the background. That's fantastic. All right, we're going to bring Will in a second, but let me just do a quick announcement. InfoSec World, you've heard us talk about it. You've seen some of the folks on the program, so you know it's going to be a blast. It's March 19th to the 21st. This coming 2018, so it's a couple days away, at Lake Buena Vista, Florida, aka Disney World. It's a great show. They do a great job. KT really works hard to produce this. As one of our delightful family members, you can save 15% off the InfoSec World 2018 main conference or World Pass, and you can get the talks from Adrian Sanabria, Diana Kelly Admoyle, Jennifer Manila. Go back, check that out here. Mark Arnold, Mateus Madau, and Summer Fowler. I caught that interview with Paul. It was absolutely fantastic. So make plans to be there, and the Security Weekly crew will be there, and happy to see you there. Also, Ben Doyle sent me a note and said, hey, you guys keep talking about the books. You keep talking about the books. You keep promising you're going to write up the books. Would you just please put the books in the show notes? In fact, he said you don't even have to send me the books. Just put them in the show notes, Ben. Thank you. Books are in the show notes. So just a quick recap, the 3 books. Play Bigger, with The Brain Audit, and Sean D'Souza. We've got that second part of the interview today, and then Never Split the Difference, which is on negotiating. If you're going to do it, do them in order. Play Bigger is great, and that's just make it a quick read. Don't worry a lot about the execution. The big thing there is this, to realize you can control your own destiny, and it's really about owning the problems. But then when you want to go figure out how to implement it, go read Brain Audit, go read Never Split the Difference, and you'll see the progression and how they all work together. So that's in the show notes, and I'll work on roughing that out a little bit better for people as we go. Some of you sent in some mind maps on it, some questions, some thoughts. So keep that going, and we'll keep it going. But let's get down to the exciting stuff. So Will Lin is back again. Good thing I didn't sing that, right? And you'll notice, or at least I noticed when he sent me an email, his title has changed. So now he's a principal at Trident Capital Security. So exciting promotions we're going to ask about. And Will, he's here. You know, a lot of you have been writing in and chatting with me about enjoying the work that we're trying to do to help explain the different rounds and what we would expect to see at that or how that goes. And you know, a lot of that came from talking to Will. So we brought him back today to say, all right, so let's go look at the VC round stuff. the VC-led stuff, and we're going to kind of have that conversation. It's perfect when Matt's here, and so the three of us are going to kind of dig into that, and there's some more stuff planned for the future as well. So welcome back, Will, and congrats on the promotion. So what does it mean to be a principal? Are you responsible for discipline, or how does that work now?
So, thanks, Michael. I really appreciate the introduction there. So principal, what it basically means is a little mini partner. Like, there's big P, like huge partner is really important. And then principal is little tiny P. So that's where I am now. But what it basically means at the highest level is that I am leading deals now. So companies that I'm very passionate about with entrepreneurs I can work really well with. I'm the lead board member. I lead the board with the support of one of my partners. And the goal is to do at least 2 deals this year where I'm the lead.
And
That's
I know where
outstanding.
one is.
Congratulations.
Hint.
Thank you. Matt has a good idea of what one of those is going to be.
Yes, I do. I keep pushing Will every chance I get. I'll see him next week at Container World too. So yeah, exactly. I always kind of nudge him. Hey, by the way.
So basically, what you're saying is your calendar went from overbooked to I can't even breathe anymore. You're everybody's new best friend.
Pretty much. Yeah, the term of phrase in venture is called check writer. So now I can write checks. So I can just keep playing checks. You guys ready for that? No, I can't do that. But yeah, so that's a big step.
I'm ready.
Yeah.
All right. So as we kind of looked at this, and just to remind everybody when we look at this, so at Business Security Weekly, the goal here when we look at these types of things is to say, okay, what's happening in innovation? And Will and I actually worked on a piece last year where we said, the modern VC, they're that stewards of innovation. A lot, and what you've seen, and we keep pointing this out in the program, is a lot of companies now, instead of doing their own research and development, they're buying at all sorts of stages startups. And so when we look at this, and it's still very core to how we look at this program, your leadership, whether you're in that startup or you're looking at evaluating startups or you're investing in startups, is going to matter. The way that we communicate is absolutely fundamental, and that's why we're going to keep focusing on that here. But while Will's with us and Matt's here, great opportunity to go into, so what does some of these rounds mean? What does it mean when you're an investor? What does it mean as a founder? What does it mean from the VC perspective? And since we've got Will here, great time to do that. So Will, let's start with just looking at some of the rounds, and let's the three of us chat about them a little bit, because traditionally there was a seed round, and then you had an A round, and then you had a B round, and it sometimes feels like, oh, let's just go down the alphabet. But what we've learned is each of those rounds has a little bit of a different purpose. I think the other thing we've seen in recent times is there's now pre-seed rounds. So there's even like angel rounds and pre-seed rounds and seed round, all sorts of other stuff. So when you look at this, where do we start? And what do we need to think about from these different roles and perspectives, the rounds?
Yeah, so, what's actually been happening is everything's just gotten later. So before we had a seed, A, B, C, D, and not every company has to raise all those rounds. It just really depends on the company. But now what's happened is we have a pre-seed, and so the seed has become the new A has become the new B, B's become the new C. So everything's basically become later. And it's actually tracked very cleanly as well. Valuation at the seed stage before looks like what pre-seed looks like today. Valuations at the A stage before look like what the seed looks like today. And so for instance, in the past, if you wanted to be a seed company and you want to raise a seed round, you actually didn't have to have revenue. You didn't have to have customers. You just had an idea, great team, you get money. Nowadays, if you want to raise a seed round, you actually have to have pilot revenue. You actually have to have customers that are already paying for your stuff. And so what it is just basically everything's just shifting in terms of definition.
So Will, as we talk through these different rounds, right, which I think is interesting, you said, a seed is what the old A was. Walk us through a little bit what some of those parameters look like for seed versus A. And then we'll talk maybe a little more about, okay, what is supposed to be accomplished as part of each round. But I think people want to understand, what are the requirements? What's kind of the criteria? And then what's the expectations on that raise for that round? Are seeds, in that under 5 million, which used to be the old A's, are they more than that now? I'm curious how each of those kind of line up a little bit.
Yeah, definitely. Happy to talk about it. So, at the highest level, let's just talk about revenue and customers. So, in the pre-seed stage, you can just be an idea and a team, and that's about it. At the seed stage, you should have some pilots. Like, they might not be paying you right now, but they should be testing your product and they're actively trying to become a customer. At the Series A stage, you should have a couple of customers. And, the high-level metric is around $1 million for a Series A. It's not perfect, but that's around where it looks like. Series B, you're 3 to 5 million of revenue. And then when you get to Series C, that's when you really found product market fit. You found at least 10 reference customers, something around that range. And now it's just pouring fuel into the fire. You want to make that fire as big as possible. And so that's why in the Series C, D, and E phase, you start seeing like $25 million rounds, 30, 50, even $100 million rounds. Because at that point, they found product market fit. They know how to sell it to the customer. All they need is just give it more money so they can grow.
I want to go back to something quick too. When you talk about basic goals of revenue, so you want to see like about $1 million. When you're looking at those deals, Will, it seems to me that there's risk. Like, oh, I got $1 million, but there are only 3 customers, as opposed to we've got 10 customers. There's $100,000 each. We're at $1 million. This is how we're able to scale. But I guess, how much of that's important versus you can come in and look at it and say, oh, you seem to know what you're doing. Yeah, you got some things to figure out, but I can see that this will scale. I can see how this fits a need. Like, is it more that you're looking for some of those subjective things and this hard criteria factors it? Or is it, you're really looking for the numbers? The numbers are what's important because they signal something else.
Yeah, so the numbers are one data point, and it's a very valuable data point. It's really, there's nothing more real than customers giving you revenue. The better way of defining Series A and Series B in terms of just revenue is talking about product market fit. So there's 2 things that you want to achieve before you get to the Series C, D phase, which is 1, product market fit, and number 2, a scalable go-to-market. At the Series A, what we're looking for, and I primarily do Series A and Series B. At the Series A, what we look for is hints of product market fit. And what we want to do during the time frame of the Series A is we want to prove that out and say, okay, you have a product here, and we can go 4 or 5 different directions. Let's focus on where to prioritize, and let's find that product market fit for those use cases. And in the Series B stage, that's when you start building hints of a scalable go-to-market, meaning you start hiring salespeople, you start giving them quotas, and you can start seeing how long it takes them to ramp up, become an effective salesperson, blah, blah, blah. In the Series C stage, everything is looking pretty solid. You just need to give them more money, and then they can grow.
It just occurs to me, we say product market fit a lot, and I've spent a lot of time figuring it out, Matt. I'm sure you have as well. Will, when we say product market fit, what does one of the enterprise security leaders need to think about for them? Like, because they're the market, right? So what does it mean when you're looking for product market fit?
Yeah. Maybe one way of phrasing product market fit, and it's not perfect, but it's parallel, is that push versus pull. So for instance, everyone here has probably we've all played Play Bigger, right? And Play Bigger is all about creating a category, and you want to educate people on this category. And once people realize, oh shoot, this category makes sense, they start saying, I need to buy something, and you're the category king, so I'm going to pull your product. And so that's sort of what we're looking for. When you find product market fit, it means that customers know that this is a problem. They know that this is you have a solution, and they're saying, hey, once I get budget, I'm going to come to you, I'm going to pull you, and I'm going to buy your product. But the thing is,
that's interesting.
I mean,
that I love explaining it that way. So then part of product market fit isn't just that, hey, look, I can reach out to these 10, 50, 100 people and show that it works. It's also demonstrating to a potential investor, and I can get the message out. People understand it. I like looking at it as that pull versus that push. That's a great dimension that I guess I hadn't really spent a lot of time with before. Thanks for sharing that.
And I think that pull comes as part of Series B, typically in the way you laid out the rounds, right? Is you want that pull to happen in your B, which then sets you up for CDE rounds later, because now you've got that pull, and now it's time to scale what's working. Is that correct?
Exactly. In the B, you start seeing elements of that pull. It's not fully there yet, but by the end of the B, it should be very clear that there is a clear pull, and maybe it's not everyone, but it's a big enough market for you to start putting money into the company and trying to help it scale.
All right. So somebody wants an investment. Somebody's listening right now. They've got an idea. Based on what you just laid out, if they've got no funding at all right now, where do they start? Or if you prefer to take it, Will, at what point do you start getting interested? Where do you start paying attention?
So for me, I'm really focused on the A and B, and every investor sort of finds a category or a section that they're really comfortable with and they have a lot of skills in. My skills and my firm skills are particularly focused on Series A and Series B. So I get really interested when I start seeing hints of product market fit. So I mentioned $1 million in the past. That's not really a hard and fast rule, right? Like it might be one customer that gives you a $2 million contract all of a sudden, right? If I can see some visibility saying, hey, that early adopter customer really wants this and we can build product market fit there, then we'll jump in. And so that's what I'm primarily looking for. It's a little bit of an art versus science, but once you sort of see hints of product market fit, you know it's there, and you say, okay, this is a Series A company. I want to fund you and build a company with you.
So based on what we've talked about then, that means that they've already been through a pre-seed or seed. So when they're at that point, it means that they've already got the ability to at least explain what they've done. They've got somebody who's paid them money for it, and they have an actual product or a service, something that's in the marketplace that you could go look at or you could talk to a customer. That about, like, is there anything else that they need to have at that point before it becomes something that would show up on your radar screen?
Yeah, so they have to have a minimum viable product that people are purchasing and using. And so, maybe another way of phrasing is they have to have at least one good reference customer, right? So like, for instance, if you have, in the scenario that you mentioned, Michael, you have $1 million revenue and it's from one customer, that customer is going to be your reference customer no matter what, because they're so dependent on the startup. They want the startup to succeed because they want that investment to do well. Now, let's say that there's a company with 10 customers with $100,000 each. Each of those individually might not be a reference, but if you add them all up together, it sort of becomes more of a real reference for your future customers. And those 10 really want this company to succeed because they want to continue using that product in the future.
I think one of the things that Matt and I try to look at sometimes, and you already mentioned, you get to these later stage rounds, you might see bigger numbers because now we're trying to fuel the growth. At these earlier stages of these A's, there was a rule of thumb at one point that, your A round is, $2 to $3 million, maybe up to $5 million. We see A rounds now that range anywhere from $500,000 to, $20 million.
Right.
Is there a rule of thumb in an A round, or are people just getting all over the place in terms of the valuations? But what should we start looking for in terms of ranges for A rounds for companies?
Yeah. No, that's a great question. You've had some guests in the past when they have a seed round that was a $6 million seed round, which is far larger than normal. And so when you see that, you sort of say, okay, that really is something in between a seed and a really early A. So let's go through the numbers really quickly. So pre-seed, it's something around $1 million. It could be less than $1 million. It could be up to $2 million, something around that range. Seed can be anywhere from 1 to 4, somewhere around. It can get bigger. So, for instance, I think Minerva, which was one of the guests in Security Weekly, or actually Startup Security Weekly, I think they had a $6 million seed. And so that was sort of something that's in between a seed and an A. A is anywhere from 6 to 12. On average, I think A's are around 8 to 10-ish. But you can see A's that go from 8 to 15. There's always unique cases. So, for instance, some companies raise $25 million at the Series A. What's actually happening there is actually raising a Series B, not raising a Series A. They're just calling it a Series A. So the way to sort of differentiate the round is by looking at the amount versus by the letter next to it.
I remember you helped me understand last year. There was somebody that they had a Series A and then they had another Series A, and you talked about the fact that when they're fundraising, they open a round, and the round might stay open longer. So even though it looks like it's 2 Series A's, it's all really part of the same raise. Is that common? I mean, when we start looking at this, because we're going to start talking in a second here about up rounds versus down rounds versus equity rounds. But what I think I just heard you say was, don't get so hung up on whether they're calling it an A or a C or whatever. Look at the amount, look at where they're at as a company. That should give you a pretty good understanding of where they are and what we should start to see from them next. So then do things like 2A rounds or second. That's just how they papered it. That's less important than looking at the amount and what they're actually doing.
So the key thing to look at is the amount as well as the timing of the amount. So for instance, if they raise 20 million and then a year later they raise another 20 million, usually that signals success, because within just 1 year, hopefully they didn't burn that initial 20 million, but someone came in and saw so much success in the 1 year time frame that they said, holy crap, I need to get into this before someone else gets into it. And so they give you another $20 million. And so what you're hoping is that company at that point, after they got in the second 20, they have like 30 to $35 million ish. Like they didn't fully spend all the money from the previous round. Then there's scenarios where they raise 20 and then a year later they're already done and they need another round. That just gives you a sign that company's burning money like crazy and they're trying to hit a moonshot, right? So there's a lot of ways to sort of analyzing the cash that goes into a company, adding in the timing, adding in stuff like how many employees do they have, adding in stuff like how much revenue, what have you been hearing from your other friends in terms of being customers, et cetera, et cetera. There's a lot of nuances to that.
Yeah. Is there a danger in taking too much money too early? Taking a big round like 12 to 15 million in a what would be a traditional A, does that hamper a company sometimes? Is there danger in doing that?
Yeah, so I think one of the this is a human nature. If someone gives you a ton of money and they say, hey, like, grow your business, you're going to take that ton of money and say, okay, well, I'm probably going to spend over 2 to 3 years. And so how do I then I'm going to start projecting an amazing growth rate because I'm going to be spending all this money. And then what's going to happen is you're going to scale up assuming amazing growth rate. And let's say you don't hit that amazing growth rate. Your cost basis is so high right now that you might actually burn all that money in a year versus 2 or 3. So there's just a natural human tendency when you give too much money to a company that they try to spend it and try to grow as fast as they can. So it happens quite a bit. And so that's why when you do raise more money than you need, you have to sort of figure out, okay, well, what's the benchmarks? What do I need to hit the next time around? Like either I'm going to try to sell this company. And if I'm going to sell this company, I know I need to get this revenue. I need to have this much relationships. I know I need to have this many customers. And you build towards that end plan. Sometimes people don't plan for that end. They say, okay, well, I just took a huge A. I want to hit my B in 2 years and I want this much revenue. But then they don't figure out that chart towards that goal. Or they don't even have a goal at all, right? And that's even worse.
Is the 2 years still about right?
Yeah.
So about 2 years per round?
It's still, yeah. It's anywhere from 1.5 years to 3 years per round. I'd say the average is probably 2.
Is there
you were thinking right? Just the way I was, Michael. 2 years on a round, right? Yeah.
Yeah, but like, is there a reason? Like, does that give you enough time to prove something out? Like, it's not just about the money, right? Like, what is it in that cycle that we're looking for over 2 years to progress to the next stage?
Yeah. This, I don't think I can call this a best practice. This is just how I feel about it. And my sense is that the first year is sort of a year where they can make mistakes. You want to give entrepreneurs the leeway to pivot if things don't work out the way they should. And so I think the initial year is sort of a time to make mistakes, and the second year is the year to prove it out. But if you're really successful as an entrepreneur, not very first year, you're already successful. And you're already growing the business like crazy. And usually when that happens, people will try to jump in and say, okay, well, I'm going to preempt this next round. I'm not going to wait for those 2 years. I'm give you the money right now because you're doing something special here.
Well, it's also right. I mean, doesn't that help you with valuation? I mean, look, I appreciate everybody wants to be fair, but everybody also wants to make money. If I delay, like you're going like gangbusters, and that next round happens a year out, you're going to have better numbers, better financials, better everything. Wouldn't that push the valuation up? So if I can get in on that next round sooner, I'm going to give you the boost. You're going to it's a win for everybody, but that's got to be good too from a valuation perspective. No?
It's a give and take, right? Because what could happen is you say, well, look, you have 1 more year of runway, and I want to invest in you right now. So what you say is, I'm going to invest in you at a valuation of 6 months later. So let's say you hit your your next 6 month target. I'm going to give you a valuation assuming that. And so there's a risk to both sides, right? So there's a give and take. It's rare for you to say, okay, I'm going to give you money at your valuation today, and then I'm just going to benefit from your next year worth of growth. So there's a little bit of paying ahead of the valuation, and you're hoping the company grows into it. And overall, I'd say that's usually what's the case in venture, especially the best companies. Usually give them a valuation that is more than the company's worth, but then you plan on the company growing into that valuation.
Oh, it's kind of like setting the goal and then helping them reach it, right? So instead of saying you're not worth as much, you're like, look, what we see, you could do X. It's more than they thought. It's fair, but by the way, then right, what we know from human nature is people will rise to that. They're gonna, whoa, if I'm worth this, they go crush it. I like it. It's not a trick. Like I get it. So then when we see people take equity rounds, is that a good sign, a bad sign, or where does that fit in this process?
I would say in general, an equity round is considered a positive versus negative. The only times that an equity round might not be positive is the scenario that you mentioned, Michael, where for whatever reason they put more money in at the same Series A valuation. And then what's usually happening there is, we gave them a 2-year runway. And maybe the runway wasn't 2 years as they planned. And then in the 1 year or however much time they had, they didn't hit the metrics they need to raise that next round. But there's a new investor that's so excited about the company that they say, hey, look, I'm willing to invest money at the previous valuation, even though you haven't hit it yet, because I want to give you that runway to actually hit that next round metric.
Okay.
What about equity rounds later, though? If you're in C, D, E, and then you do an equity round, is that still viewed the same way, Will?
So, one of the key things, and this is something that you guys brought up earlier, is that if you raise an A, that means you've already raised a seed, and if you've raised a B, that means you've already raised the A. Some of the most impressive companies are able to raise like a Series B valuation without ever raising any money ever. And the reason they're able to do that is, one, maybe they spent a lot of time building the business, being break even, and growing in small bases. Or maybe they hit a gold mine in the market, and they realized, okay, well, there's such a pull factor here. I didn't need to spend $1 million, or let me rephrase. I didn't need to spend $10 million of Series A plus Series B in order to hit $10 million of revenue. I already hit that with only $2 million of revenue, or $2 million of funding. And so, one way of thinking about companies is comparing the revenue runway versus the amount of money that they've raised. And in my opinion, and every investor is a little bit different, but in my opinion, I really respect companies that are able to get more revenue than they've raised. So, for instance, let's say there's a company that's raised only $2 million seed, and they've already hit $10 million of revenue. That's super, super impressive. Because normally, in order to hit $10 million of revenue, a startup needs like $30 million worth of cash. Sorry, I went on a tangent. To answer your question, Matt, the later rounds, those are very opportunistic. The reason why they happen is because this company wants to avoid IPOing, or they just want more runway before they go IPO. Because being an IPO company is there's a lot of overhead to be a public company, and sometimes it just isn't worth it to everyone. And so they say, okay, well, I prefer to just take another really, really large private round, and that way I can continue building this business. And there's also a competitive advantage sometimes to being a private company versus public. Because when you're public, everyone knows what you do, everyone knows your revenue numbers. If you're private, you can go under the radar, so people don't know what's actually going on.
Yeah, and there's a couple examples of that in the market. And I'm just curious, what if you can't go public? Then do you just keep raising equity rounds till you get sold? Is that what happens from an exit criteria perspective? I'm just curious, because I've seen a couple of these where they will take an equity round, another equity round. Does that just mean they're delaying an IPO and they're not ready for sale? Will that continue? Could that continue?
Yeah, I mean, it can create some really dangerous scenarios where they keep on taking these rounds because they're growing, but there's really no exit path for them. And there's also a possibility where you raise too much money and it reduces your acquirer options, right? So let's say you want to start a company for $100 million. Almost every single acquirer out there in the world can afford that. But let's say now you're worth $1 billion and you just raised around at $1 billion. Those investors that gave you money valued at $1 billion, they want your company to sell for $2, $3, $4 billion. How many acquirers are out there in the world that can buy a $2, $3, $4 billion company? Not very many. So it reduces that amount. And so if the ultimate goal is to get acquired, you have to be very, very careful about how much money you raise. If the ultimate goal is to go public, then you're going to have to deal with public scrutiny. And very many times, someone will raise a private round, and then they go public, and the public valuation is actually lower than the last private round, and then they creates all kinds of funkiness. So, there is a lot of danger to basically mispricing around and raising too much money.
All right, we got a minute or two left, and then so what we're gonna do, Will, is you're gonna come back, Matt. You'll make sure you're with us for this one. I want to talk a little bit about in the future. So I'm just setting the stage for our next conversation. What the business leaders need to know when they're evaluating startups. So, for example, they find a startup that they really like. How do they help? How do they contribute? Because I think at the enterprise level, working with startups is different, and I think it creates a lot of opportunities for people. But there's something else that Matt and I've been talking a lot about. The size of the exit, when it's disclosed or not disclosed, there's two questions to it. Does it matter if they disclose it or not? Like, is not disclosing the exit necessarily bad? And when they do disclose it and we look at the number, should we compare that against what's known in terms of the raise, or should we look at that in some other capacity to determine good exit versus or not a good exit?
Yeah, no, it's a great question. It's a long answer, so I'll keep a summary version of it. And the summary version, it basically is generally undisclosed acquisitions are small, like sub $100 million. And depending on how much money they raise, it might not be a successful exit for the investors and for the company. And so when that happens, they generally try to keep it undisclosed. When it's a huge success, generally they let that information leak, and everyone knows about it. So that's just a high level rule, but it's not perfect.
So when we point out, we say it was undisclosed, and it looks like, they're all going to go over and work for that company and keep their jobs and titles. Sometimes that's what we call the acqui-hire or whatever. We're not necessarily wrong with that. We might not always be right, because I can see where some of the private equity companies are probably, as you pointed out, being a little coy with things. They're keeping stuff a little tighter. But for the most part, the disclosures matter. So then if I'm evaluating, so let's say, and I know Matt and Prep put some stuff in here. So let's take a look. Invincia, they were acquired by Sophos for $120 million, 5 funding rounds, about $55.5 million. So based on what we know, 5 rounds, $55.5 million raised, acquisition for $120 million. So is that are we looking at a 2x return? And so it's good in that nobody lost, but that's not that 5x, 10x that everybody's hoping for. Is it is simple to look at it that way?
I think it approximates the exit. So the key thing to remember is that, sure, they might have raised $55 million. I'm just going to round it. 50 sold for 100. They might have raised 50 and they sold for 100. But what did the entrepreneurs get, right? Like, the $50 million represents the investors. And then there's a big pool between 50 and 100. How much of that 50 and 100 did investors get, and how much of that did the entrepreneurs get? So I would say that exit was probably a okay exit for them. The investors probably made 1 point something. They didn't make 2 because some of that 50 million gain had to be shared between the investors and the entrepreneurs. And usually when there's such a small gain versus the amount invested, more of that 50 should go to the entrepreneurs. So maybe the investors made like 1-2 or 1-1. They didn't make 2x on that one. So it was an okay exit. Yeah.
Oh, I was going to say is we're definitely going to come back and do that. So there's some other questions we have from both the founder's perspective and the business perspective. And you and Matt will come back. Will join us again in another month or two, and we're going to go through that. So if you're watching and you've got questions for Will or Matt, and you want to understand a little bit better the innovation side of it, things that we've been talking about here that you've wondered about, these are the experts, and I'm going to be happy to ask those questions of them. So you can shoot me a note or hit me on Twitter @Catalyst, and we'll work that up. We're going to take a quick break. which is a good chance. Check us out, securityweekly.com. You're going to find we've got a ton of shows covering enterprise and community level events, and we'd love to do that. When we come back, we're going to talk about the foundation that launched this week, $50 million investment, why we think that's good for security.